Hello everyone, how's it going? In this video, we're going to talk about Mullen Automotive, trading under the ticker symbol MULN. As the market has been very volatile and active over the past few months, and the future outlook looking as uncertain as ever, we will go through the latest fundamentals, the price actions, and my analysis as well as recommendations to hopefully help you make the best decisions possible. So, Mullen is in the EV manufacturing, distribution, and marketing business. It acts as a holding company for several brands and companies that they may purchase or have already done so along the way. The latest example includes ELMS and the EV trucks operations. The company began in 2014 and it is the successor to Coda Automotive. Another company called Mullen Motorcars was also founded back in 2004, I think, and created Mullen GT, which was one of the earliest EV supercars back then. Overall, it's very convincing to say that Mullen is an EV veteran and has a long track record for us to appreciate. But see, appreciate usually comes with like a positive spin to its definition. In this case, it's more neutral. It just means that it has a long enough story for us to take a look and to make our own mind. Because this is the third or fourth time that Mullen is trying to make itself work. And we have to wonder why the previous ventures did not. Other than like the most obvious examples of, well, because a business doesn't always work, and oh, because, as a car manufacturer, you don't always know what you're doing. Other than these, it's also because the EV sector is very nascent from the business perspective, not in people's mind. People have already accepted by this point that yes, cars can be electric. They're just not ready to pay the premiums for it, although the premiums hopefully will go down as time goes on, right? So far, Mullen has demonstrated that yes, the interest is there, the concepts are interesting, but they may not have enough capital to keep themselves going until then. With that being said, the recent price action has seen Mullen share price reaching around 30 cents, down by more than like 40% compared to the peak of the stock. And chances are by the time that you're seeing this video, maybe the price has already gone down to like 26 cents. This is entirely possible. The price movement would be particularly bizarre if we take into consideration the latest news, which I think for all of them, they were positive. The latest one that I saw was the company reduced a huge amount of its debt, something like $13 million. So the actual reasons why the stock might be down could just be because of the typical ones. There's a war going on, there's interest hikes, the tendency for a lot of shareholders to sell the news or to sell the good performance. In other words, somebody holding Mullen shares for quite a long time, they saw like a spike. They saw a spike from 25 cents to 50 cents. Well, what would they do? They may choose to liquidate their position. Okay? This is just human. And also, like every single time when I say, okay, please respect the exposure to which you set to yourself. Well, many people I've noticed seem to have like a huge position in those penny stocks. So if a third of your portfolio is like in Mullen, then yes, there would be reasons to worry. And yes, if the stock has been, a bag holder for a long time, and all of a sudden you have the opportunity to get out at a slight gain or even a slight loss, a lot of people may choose to take it. This is what almost happened to me with Lucid. So I was holding Lucid around, I think, high $20. And when it finally came back from like almost below $10, well, yeah, I immediately sold my shares. And by the way, that kind of price action didn't really last with Lucid, as right now, it's still on like the low end of the spectrum. So this is just a tangent regarding like stock shares performance. And this is also why sometimes I wouldn't recommend people to trade the news, because even if the news are good, it may simply confirm a previous assumption. And by doing so, you know, the stock would kind of just tank afterwards, because everybody would be like, oh, you know what, the good news are confirmed, and now we can move on to something else. Now, over the long term, the company has been having a mostly bearish trend over the past 5 years, having traded between $5 to $10 for years before peaking around $15, and finally falling around a penny stock level in the recent month. This is why some of the comments that I received were like, oh, you know, it's funny that you're still shilling for the penny stocks. Well, I mean, they didn't pay me for anything, right? But at the same time, it wasn't a penny stock for a long time. And if people want to trade it, it's because they wish that it no longer remains as a penny stock. But on top of that, I would say that it's also worth to explain why sometimes people, myself included, we cover stocks like Mullen, we cover stocks like Palantir, we cover stocks like SoFi. And for those who still remember NAT, North American Tanker, or Imperial Petroleum. So a lot of people choose to like cover those stocks inherently because they attract views. They attract like reach. They increase the reach of our channel. And this is why, you know, for a lot of those videos, it doesn't mean that I necessarily support the idea of buying them now. And in fact, I often don't. But my point is, because people like to watch those videos, they like to watch those companies, this is also why we cover them. It doesn't really always mean that they're necessarily fit for purchase right now. So online communities, along with media outlets, have been skeptical about, you know, where this company might go. In recent weeks, I've noticed that the amount of positive stuff has increased, with the benefit of hindsight, of course, which means that a lot of media outlets saw the upcoming momentum. They were not sure where this is going to go, so they were all trying to play safe, meaning they try to say, oh, you know what, Mullen might be the next Tesla, this might be the next Tesla, that might be the next Tesla. Yeah, but even Tesla may not be the current Tesla, if it makes any sense. So this is why I feel like sometimes reading the online articles, they just confirm yesterday's news. They just confirm yesterday's news that they didn't necessarily participate in the creating. When Mullen was going down to like 25 cents, I didn't see that many people having a lot of faith in like the capacity to take off of this share. So anyway, I would say that those news can be read for entertainment purposes to confirm or to deny your current thesis. They should certainly not be read as a tool to predict the future. Same goes for mine. I mean, my videos, yes, they have a component at which it tries to predict what's going to happen going forward. But at the same time, the vast majority of it is being used to explain the present and the past, right? And all my videos are pretty much like this. And in fact, the videos that, in my humble opinion, okay, the videos that will tell you with certainty what's going to happen usually don't age very well. I used to watch, like, you know, stock analysis videos of people like Jack Spencer and of Chris Sane. You know, it's sometimes painful. But this is what they're supposed to be. Like, they are just supposed to be content that you watch to see if there is a certain aspect that was covered or not. Moving on. So the profile of Mullen is mostly like retail oriented, and it gives me the impression that this company is good mostly for trading. Whether it's ready for long-term holding, I think asking the question is kind of answering it. Absolutely not. I think that this company still has to prove a lot of things before people can trust it with long-term, with long-term capital. With that being said, let's also talk about like why is that the case? Yes, we're going to talk about like the overall industry trends in a second, but apart from that and the fundamental issues, another issue that I sometimes feel that is not, nearly as talked about is that Mullen doesn't strike me as a company that takes things like reliability or transparency very seriously. Because otherwise they would not have disclosed the fact that, oh, we're gonna be having a big client or an important commercial partner, and they're not disclosing their names. Or they're not gonna be like, oh, good news, right? This is in fact one of the only fundamental positive news recently, other than the liabilities going down. So they recently said, oh, we're going to be distributing iGo cars in Europe, but they never managed to disclose who manufactured those iGo and what kind of risks they may present to themselves if they put like Mullen's reputation on that deal, right? So just briefly, iGos are compact EV cars that are made to, in my opinion, deliver like food parcels or just parcels from like Amazon and that kind of stuff. So it is good for like auto entrepreneurs who basically hire themselves to subscribe on different platforms and to deliver goods. Because it's small, it's cheap, only 12k euros. It's made to be driven in like small European roads. So yeah, it's a smart setting. It's also an interesting proposition. The question that we can legitimately ask ourselves are, one, if Europe has a solid economy in the upcoming quarters to support this kind of deal, and two, could there be any sort of, significant risks in terms of quality regarding the iGo vehicles? We don't know for both. And I have to say, I almost hope that we don't have to ask ourselves these questions, because by the time that push really comes to shove, we would have already exited from this position. Maybe that's not going to be the case. In that case, it would just be additional risks committed for Mullen. So the trends within the EV sector and the growth stocks in general has been, well, things are kind of under pressure due to the increasing interest rates, the phenomenon of capital flight, so reverse capital flight back to like other corners of the financial markets, the worldwide conflicts, and also the bearish expectation of a long-due recession, the kind of recession that should have begun at the end of 2019, but artificially maintained or artificially delayed, I want to say, because governments around the world, some governments around the world, decided to dole out like subsidiary money for people in lockdowns. So all these elements reunited together suggests that as far as riskier ventures are concerned, there's just less money that's interested to be put in there. So we've been talking about like the reason why Mullen is an interesting stock. Two additional reasons why you may think about it. Number one, it doesn't always follow the general trends. So in the recent weeks and months, I would say that if anything, it didn't follow the trends, because the trends only fell by like, 20 to 30%, but Mullen has fallen significantly more. So it's not necessarily something that's worth bragging about either. But at the same time, we must recognize that Mullen doesn't always follow the macro trends, which in the current environment may be something to think about. The second reason is probably more important, and that's because there are a lot of people hoping that there's going to be a short squeeze for Mullen in the upcoming weeks and months. Mullen has a huge, and I mean huge, short position, or short positions, put in by different institutional shorters. And their intent is to borrow those shares now dump them in the market and hope for the share price to dip lower before, finally buying them back for a profit. Now, imagine if the share price of those securities they've decided to short went up. Then they would be probably forced to redeem those positions, because as long as the short positions remain open, they have to incur financial fees, which diminishes their profit at the end. So the longer it takes, the less money they're going to make. And at the redemption, this would act as a second purchase. So this is the idea behind short squeeze. At least my definition of what a short squeeze is supposed to be. So please let me know if it actually has a different meaning. Like it's not retail traders coming in and pushing out the short positions, forcing them to redeem and triggering like an even bigger price jump. If that's not the case, then please let me know and I will correct this assertion of mine. So if we look at the financials of Mullen, the cash balance has been increasing year to year, although we would have to wait and see what's going to be the cash level during the next quarter results. It has recently diminished somewhat from like 105 million to around 84 million. Overall, it's not a big thing. It's not a big issue. And I don't think that this alone is suggesting for additional dilutions. On the other hand, dilutions is something that we will have to, look for around the corner. If the company doesn't increase its operating revenue, which is supposed to have in the upcoming weeks and months when the IGO distribution program begins. On the other hand, the liabilities show some pretty optimistic signs, because it is beneficial to the long-term survival of a company to remain, to keep the liabilities low. Otherwise, the company might go insolvent, right? So this recent news of saying that they have managed to remove more than $10 million of debt is for me an excellent news. It means that the company is now more financially sustainable. It has lower bankruptcy risks. It has less pressure on the cash flow, although for the cash flow, they may also have less of it, right? Because they have to pay back the debt with something. But the market's timing makes these things a little bit more convoluted in the interpretation of, is it a good or bad thing? Because in the same period of time, the share price has been sharply declining. This likely shows how the market is not always taking into consideration the company's specific fundamentals, but just puts more importance on the overall trends. So if we look at the profitability, there has been no revenue since the beginning of 2021. They have been trying to keep research and development up, or increasing at least. This is a good sign. But the operating losses keep digging holes, which will force the company to eventually dilute or to take on more debt to keep the ship afloat. And this problem is hopefully alleviated partially with the IGO distribution contract. Overall, the financials of Mullen shows us the big picture of a company doing its best to stay afloat, to control the cash levels, and to keep the expenses as low as possible. Still, they still have to have operational positive cash flows in order to make things, in order to prevent things from going worse from there, or to be delisted from the NASDAQ and to cause even going concern issues. So overall, I would say that Mullen is certainly an interesting mix of low and high-end products. Its clientele are separated in two kinds. Number one, the retail clients are similar to the one of Tesla, but maybe a little bit lower end than this. So they're aiming at the medium and the medium-high tranches of the market. Their SUV cost about $55,000, which is the average or the medium, in my humble opinion. Now, the second branch of their clientele are probably the small entrepreneurs, the people who choose to subscribe themselves on different platforms to do the gig economies, to deliver goods and food parcels in Europe. So these are the two clienteles that I can see. So overall, yes, it's an interesting mix of low and high-end products. Now, the shareholder composition. The shareholders are mostly retail, which means that they can be volatile and reactive to any price action movements, which makes Mullen a good stock to trade in the short term. There are some institutional shareholders, and their number may be increasing in the upcoming weeks, hopefully. But it's still not significant enough for me to put in the money for the long term and not minding the short-term price fluctuations. At the same time, this lack of institutional participation also means that, we shouldn't trust it too much at the current stage, and frankly, it has been confirmed by their relative lack of transparency. So yeah, in that sense, they all fit in one into each other, and I would say that it's better to stay day trading or trading the short-term swings of Mullen for the time being, or wait for the short squeeze. The risk factors, like we mentioned before, include the interest rates, the VIX, the money supply issues, like we are currently into some kind of quantitative tightening process, the conflicts around the world that is forcing a lot of economies into recession and fueling the higher interest rates. And also, how long before Mullen's shareholders, us, we start to lose faith? So these are all the questions that we have to ask ourselves. Now, what kind of people is really good to become like Mullen shareholders? I think that it's people who are comfortable with very volatile titles, people who have enough money to have a very diversified portfolio, and people who wouldn't mind losing a significant chunk of their Mullen position because of this volatility that I mentioned. So if you fit the description above, then it can be something to think about to put in some of your money into Mullen. Is now a good time to buy? I would say that on Friday, the price action has been supporting around the 30 cents or the 28 cents level. So if the stock manages to maintain itself there, and that on Monday it doesn't fall back lower, this could be a good timing to start buying the stock. The maximum exposure for Mullen should be between 0.5 and 1%. Anything that's higher than that may cause people to constantly think about the position of Mullen. And this is not something that you want to be doing when it comes to a penny stock, essentially. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital, with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect in investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks, with the expectation that they will be loaned to businesses. Normally, that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.